It's winter time and it's one winter for the books, both physically and on the financial markets. Lots of ups and downs. I certainly have enjoyed the winter to the best of my ability, trying to go skiing with my kids and enjoying brisk walks with my dog. But certainly, speaking of the markets, it's been an interesting season, both on the private equity standpoint. We've been seeing a freeze of assets kind of leaking away or moving away from real estate. And we've been seeing a lot of movement in the markets. Initially, some positive noises, and then some major write downs on the tech market at the time of this recording. And so then the question then becomes, how do we time the market? Is it possible to time the market? I think that there's certainly a very strong argument for building towards making sure you have the right assets in your mix. I can't tell you how many times I have difficult conversations with clients, and it almost always stems from having a too heavy of a weighting in one certain asset. Maybe it's too much in their business, or too much in real estate, too much in investment real estate, or maybe they've got too much in the equity markets and it's making them nervous. And therefore, when you see write downs in the certain subsections of the equity markets, it really stings. And so every time I have a conversation, it's all about how do we strike the balance in one's portfolio. But when it comes to timing, and truly what I mean by timing is guessing, and perhaps even educatedly guessing when to get in and out of the market. When is it a good time to buy and when is it a good time to sell? You know, Vanguard did a study in 2024, that showed the S&P 500 from a range of 1988 all the way through to that time period when it was published in 2024. And they showed the market in that entirety time. And if you just bought the index, would you know it? That if you took $100,000 and you put it into the index, can you believe it? It would be worth $4.9 million. Sign me up. What a great result. 100,000 to 4.9 million. But if you tried to time it and you just happened to miss the wrong days, man, the effect is major. And by the way, the best performing days in the market typically happen short cycles after the worst days in the market. You know, a lot of portfolio managers talk about that a 10-day window after the worst days in the market is typically when you see the most largest jumps in the marketplace. So think about that for a moment and trying to time the market. The worst days in the market, if you lose the worst days in the market and mix it with missing the best days in the recovery of the market or the growth in the market, and you miss just the 10 best days over that same period of time, that $4.9 million drops dramatically down to $2.3 million. Now, if we multiply that even further, you miss the 20 best days of growth in the market, it goes down by half again, down to $1.4 million. And again, it just is further compounded. If you miss the 30 best days in the market, now you're way, way down to just $0.9 million. It's dramatic. And I would encourage you to think about, what does it mean to have your portfolio balanced correctly, but invested, deployed, growing for you appropriately. We're here to help. Here at Ardill Group, our door is always open. And in the weeks and months ahead, know that we're always here to help. Hope you're having a great start to the year. We'll talk to you real soon.